Um, so now we can talk a little bit about all of the assets that have that we're going to, that basically all of us trade, and kind of take a look and see what happens in 2026. Do you want to give us up to date, Alex? What we're going to talk about?
Yeah. We got to pivot into the markets themselves. Forex, indices, gold, oil, and cryptocurrencies. These are always the heartbeat of everyone's trading portfolios and strategies. Boris, as we move on from the macro into the actual tradable opportunities, what are you seeing as most important cross-asset themes for 2026?
Well, let's take them one at a time. Let's take a look at each one of these assets in its individual sense, and sort of understand where things are and where things could go. When it comes to indices, of course, the dominant index that everybody is looking at is NASDAQ, because that's the technology Latin index. And of course, technology these days means AI. And of course, those are all stocks that will be in focus again in 2026. I don't think we can get away from the idea that AI is the dominant theme of our time, both economically, culturally, and politically. And the amount of money that's just being spent on every aspect of the AI chain, from semiconductor production to energy production to everything else, is not going away, because the spend now is viewed not only as an economic necessity, but almost as a national security matter, which is why you see the United States government getting involved in many of these sectors, because it's no longer just, it is almost an existential technology. It's not a situation where, I'm going to make a better widget if I have AI. It's really becomes a situation where if I can have control over AI, I literally have control over humanity, because that means I can create machines that can collect resources for me and produce resources for me and allocate resources for me far more efficiently than any human being can. And that's an enormous amount of power. And I think that's what you're seeing the major economies across the world, or at least two economies across the world that are really seeing this as a true battle for existence, China and the US, coming in, because those are really the only two economies in the world that have the economies of scale to be able to truly produce this next wave of technology.
Well, do you think that tech and AI stocks will lead again in 2026? I know we've seen kind of a drawback from them, but it's not necessarily a bubble popping, it's more just deflating. Do you think there's a bubble in the industry?
Yeah, I mean, I think there's a bubble, I think, is one of those terms that that we use very loosely. Do I think that we're in an overvaluation wave? Of course. And anytime you have transformational technology, it's a story of capitalism. You always have not just small, not just even moderate, not even just extreme, but super extreme overvaluation. That's literally the definition of capitalism, is that you overinvest into these projects. 95% of them fail, but the 5% that survive produced 1,000-fold increase in productivity and progress. That's just the nature and aspect of the beast. Most people have to fail in order for a few to succeed, in order for everyone to become richer. It's kind of the ironic model of capitalist formation. And I think it's exactly what's happening. Now, the question is, are we popping? Not yet. I mean, yesterday we had NVIDIA come out with numbers, and they were far better than the market thought, and they guided higher than the market thought. The analog that a lot of investors are making an example of is it's not 2000, it's actually 1998, which I think is probably pretty accurate. In other words, we probably have another year of pretty interesting growth and potential in the AI world, simply because there's just so much more improvement that can happen before it finally kind of hits a wall of compute and energy and everything else. So yeah, I would say overvalued, yes. Bubble, no. Can it go higher? Absolutely. So
yeah, absolutely. I mean, OpenAI planning to spend $1.15 trillion on data centers.
Right.
And I heard you speak earlier about the comparison between the AI bubble, so to speak, and the dot-com bubble back in the late 90s, early 2000s. And the biggest difference you said was profit, really.
Yes. I mean, it's, in the 2000s, you had pets.com, which was based upon clicks, or you had I forgot what the supermarket there was a startup that raised $1 billion to deliver groceries to people, which was just really the stupidest thing in the world. And of course, none of these businesses had any revenue, much less profits. The difference now is these businesses all have massive revenue and massive profits because, first of all, these are not physical business, but digital businesses. Digital businesses, by their very nature, have like 80-90% margins. So as long as you have revenue, you almost by definition are going to have massive profits, and they all do. So we look at with scorn at ChatGPT and OpenAI because they only have like 25 billion in revenue, whatever it is. But like in any other normal world, that's an incredible achievement in 2 or 3 years worth of existence as far as a viable company. So that's the difference. Is that yes, they're overvalued, but they're actually very, very profitable businesses. And for now, I don't think you can discount them. I think it may be too early to sell it short at this point, as far as indices go. And then the other aspect when we talk about indices and FX themes here is the big aspect is the yen positioning, the euro positioning. All of that is really going to be very much contingent. With the yen, of course, is will the Bank of Japan be the counterweight to the prime minister? Will the Bank of Japan begin to tighten policy because the prime minister is just going to go crazy on the spend side? Whereas on the European side, will the European Central Bank actually act as a counterweight to the very dour situation that's happening in Europe? Because they need as much stimulus as possible. I mean, Europe is really the sick. They say Germany was the sick man of Europe. Europe is the sick man of Europe these days, in a sense that it's really not, trading very, very well. And we'll take a look. Actually, I mean, I think looking at FX currencies, it might be a really good time for us to just take a look on a technical side at what the currency markets are telling us from a pure price point of view. And to that effect, I kind of want to share with you something that's very new, unique, that we created at BK for all of the Eightcap traders and all the Eightcap customers and all the Eightcap customer wannabes, that if you want to become a customer, that I think could be very, very useful. So this is something that we created for the Trading View platform, which of course can be traded with Eightcap funds, because Eightcap trades on TradingView across many of your accounts. Just simply ask your rep how to create a TradingView account on Eightcap. The thing that's very, very cool is this little tool that we created called the BK Trend EMA Meter. And what this does is it gives you a single eagle's eye view of the various selling and buying pressures in whatever aspect that we're looking at across multiple time frames. First of all, this is completely configurable. So like if you look into the settings, you can set both the EMA values and the time values to your liking. But this has been created by my partner, Kathy Lean, who many of you, of course, know, who's a great FX strategist, as her best read of what a market is telling you. So, for example, if you look at this at the euro dollar, what we see now is kind of very much a mixed picture, where it's mildly bullish on a very short-term basis, but really pretty bearish on a longer-term charts as far as a position. And depending on where you are as a trader, you could use this to help you guide your trading decisions. Now, taking a look at something like the pound dollar, which is right here, we see a more balanced picture, really a stronger picture on the short side. There was a more positive view, right? What do you think the yen is going to show us? What do you think the yen is going to show us? I think the yen is actually surprisingly showing. No, not the yen. This is the dollar yen. The dollar is actually showing quite a lot of strength against the yen, right? And I think that's a really interesting thing. So look at what the dollar is on a 4-hour daily chart. That I think is the market basically saying U.S. yields and U.S. rates are really not going much lower. And of course, dollar yen is very, very sensitive to any increase or relative increase in U.S. rates. It really drives that currency higher. So when you were talking about, hey, could dollar yen break the 161, recent highs? the chart is kind of telling us, yes, it's looking very strong on it.
By the way, you were correct about the 1970s. It was 358 was the highest that the
Right.
yen got
I mean,
to the dollar.
I don't think anybody in Japan or anywhere else across the world wants to see that level. But, FX is a crazy business. It doesn't have to go down there to really create, I think, a lot of very interesting trade ideas for us. This is dollar Swiss, also showing us pretty significant dollar trade. And by the way, look how cool this meter is. And as I said, this is completely free for everybody in the Eightcap family. Just simply, contact your Eightcap rep, and I'll be happy to tell what you need to do. Just sort of if you're kind of interested in putting this on your charts, you need to be number one, an Eightcap customer with a funded account. That's the only thing I ask you to do. But if you are that, I will create a special form for all the Eightcap sales reps. You just call them up. You just fill out this form, which would require you to give me your TradingView ID. And once you give me your TradingView ID, I will light you up, and it will appear in your invite only folder, and you'll be able to use it to your heart's content as a tool. So it's kind of my little gift for being over here in Melbourne and bringing you some very, very cool stuff to be able to make your trading decisions even better. Now, let's take a look at the last 3 currencies, which are all commodity currencies, and see what they're showing us, because this is a really interesting story. So first, dollar CAD. Dollar CAD is literally all green, right? Now let's contrast that with Aussie dollar, which is really interesting, right? The Aussie dollar is all red. Now you would think, oh, that's 2 separate stories, but it's actually not. What that's showing you is that the dollar is strong against the Canadian dollar because dollar CAD is inverse, and it's strong against the Australian dollar. And what that's basically showing you, and then of course, I don't
some good news yesterday also on the CAD with the BOC consumer price coming out at 2.8%, or I guess it was 2.9, or previously 2.8.
Right, but the overall picture, I mean, if you look at this, if you think about this, this is just telling you commodities are really depressed. These are 2 of the largest commodity economies. And against the dollar, they just red. I mean, dollar CAD being green is the same thing as CAD dollar being red, right? Remember, it's an inverse pair. And Aussie dollar all red. Now, you could say, and this is, I think, a really interesting thesis and worth exploring, that when you have something super, like when every cell in this particular indicator is one color, it doesn't necessarily mean that that's the signal. You could say that that's actually an oversold or overbought signal, right? Because very often when I see this, when it goes all red, you start to see some of the tiles begin to turn green, and then turn more green as you get to sort of grossly oversold conditions. And if that's the case, then when we talk about oil and the other commodities stories, you could need to see that as kind of a guide to perhaps maybe the story on the commodity front is kind of overdone. But for now, what you see on the FX front is, of course, tremendous weakness on the commodity currencies. BK Trend EMA meter, just kind of showing it to you in the best way possible. Again, you guys like it? If you find it interesting, I'm actually curious. We'll see in the comments. Let me know if you guys like it, if you like to get it, and I'll be happy to set that up. Or if you like to see any other ideas. By the way, I'm just showing you the EMA meter, which is a much more sensitive one, because EMAs, of course, are more sensitive than the SMAs. But Kathy also made an SMA meter, and you can use both. And she even has a little bit of an explanation of how you would use one versus the other in terms of doing positional versus tactical analysis of the markets. So hopefully you find it really, really useful. It's our little gift for you guys as we bring it. But now let's kind of change and turn our attention a little bit. I think to the equity market, because we talked we of course talked a little bit about indices, but it's worthwhile for us to kind of examine the central tug of war, the central big problem within the equity market, which is this. And we kind of revealed it with NVIDIA. Yes, U.S. stocks are overvalued. Right, and the classic conventional idea is like whenever we go to 23 or 24 times forward earnings on the S&P, that means the market is ready for a massive correction because it always reaches its apex points of overvaluation. And that would be true if that was just the end of the story. But as always, there's two sides to the story, and there's no more than two sides to the story than when it comes to the equity market, where the growth part has actually been completely underestimated. The flip side of companies charging ridiculous amount of money for everything they do and still having the pricing power to do that is that they're just raking it in on profits. Now, you may not like that, and especially if you're a progressive, you certainly aren't going to like that. But from a capitalist point of view, what that means is that earnings growth actually has been exceeding expectations. And what that means is that the denominator may be going down. So if you're 23 forward earnings, but your earnings are growing 10%, you're no longer overvalued. You may just be fairly valued. And that tension between the growth in earnings and the overvaluation is really what's going to, I think, drive the story going forward. If the Atlanta Fed is correct and we're running at a 4.5% growth rate, and if the U.S. economy continues to kind of totally outperform the rest of the world for the next 6 months, it doesn't matter if the equity markets are overvalued. They're going to rally higher. They're going to go much more higher, and that I think is sort of very, very important.
We're seeing a healthy retrace at the moment for sure with the equity markets.
Right, exactly. And let's take a look. Let's take a look at the equity markets just from the technical point of view, just for a little bit. I want to take a look at Nasdaq right now as an equity market, and what you see on the Nasdaq side is still a predominantly on the longer term time frames positive story. What you see on US 30. Where's my US 30? Oh, here's my US 30. What you see on US 30 is even a better, or for a while, it was even a stronger positive side, because while people were shifting away maybe from technology, they were still going into more defensive US stocks, believing that they had a relatively bright future. Now it's actually, you're right. Correction, if you look at the technical meter right now, you really can't get too excited about being a buyer right now, because it is starting to turn pretty negative across all the time frames, even on the longer term time frames.
Can you put on the day chart? I'm curious to see what it is.
Yeah. So,
or just the 8 hour if you can.
Okay, let's do the 8 hour chart. Well, this is the 8 hour chart on the US 30, right?
Yeah.
Which, I mean, it's
that's
really,
a pretty healthy retrace.
Yeah, it's a pretty healthy retrace. But in the grander scheme of things, it's healthy in nominal terms, 48,000 to like 46,000, but it's only like 5%. I mean, it's really not a lot, right? I mean, could we go down to 40,000?
Yeah.
Yes. Could this whole screen turn bright red? Yes. And maybe that's would be actually the right time to come in and buy the dip. But yes, I mean, the picture is mixed. What it's basically showing us, both technically and kind of fundamentally, is it's mixed to the downside. But it doesn't mean that it's in the beginning of a complete bear crash market. What's interesting that I think is people don't quite appreciate is the surprising strength of the German market, given the very, very negative aspect of the European economy. And maybe this is kind of showing you technically that the European equity market is washed out. Like, in other words, that there's maybe it's so cheap that it's actually a bargain, even if it doesn't have nearly as much growth as you think it is. And even if if it just picks up a little bit of growth, it has a huge inflection point to the upside. Like the story of being long US, short Europe for the last 10, 15 years may be the opposite story these days, where being long Europe or long DAX against short Nasdaq might actually not be a bad idea as we go forward. So it's sort of kind of interesting when you look at the text and what's going on here as far as clues on the price front. But of course, the asset that has outshone them all, that is the shining light in everybody's eye, the gleaming asset in everybody's eyes, the thing that glitters, is gold. And gold has been the big story of this year. I think, when you look at the key themes this year, the gold story has been absolutely the cleanest winner for a whole bunch of reasons. The most obvious reason, of course, is sovereign debt risk, right? All across the world, what we're seeing is global economies overburdened by very, very large debt service problems. U.S. economy, I think we're close. We're not quite there, but where the service on the interest rate, the debt interest rate service is almost becoming the single biggest line item on the budget. That's just so toxic.
What's current debt at? 35 trillion only?
35 trillion. Yeah, 35 trillion. As Sam Rayburn said, a billion here and a billion there. Pretty soon you're talking about real money. I think that needs to be updated to a trillion here, a trillion there. Pretty soon you're talking about real money. But U.S. is, of course, not the only economy that's just kind of drowning in its own debt. UK as well. Quite a lot of European economies, even if they don't have as bad a debt to GDP ratios, they don't have nearly as much growth to be able to service whatever debt they have at this point. So all of that has really driven a lot of institutional flow into the gold market. And also central banks themselves, most specifically, the Central Bank of China has really realigned itself from just buying pure U.S. treasuries to now trying to buy hard assets with gold. And the one thing I think I'm pretty confident in as far as macro forecast going forward is that this is not the top for gold. That gold as a asset of attraction in this highly political, partisan, geopolitical framework remains and will continue to remain a very, very viable asset. When you look at it sort of, from a notional point of view or like from a real, gold expressed in real US dollars, we're nowhere near the potential blow off top that we could be. It's not inconceivable for us to maybe go $7,000, $8,000 before gold really kind of hits that blow off top that it did in the late 70s. So gold, when you look at it, and we can take a look at gold here on a chart basis. Let me just pull that up. Where's my gold? Here's my gold. And it looks mixed, right, on a longer term chart basis. But again, it's sort of the story of a correction, not a massive decline. You could make the argument, actually, what's interesting is that gold,
it's a bit of a rest more than a correction.
Exactly. It's
having a quick nap.
Yeah, having a quick nap. That 4,000 level is just being tested and tested and tested. I wouldn't be surprised if they break it and they try to take it down to maybe 37, 38, because the markets tend to always want to break the key support levels just to sucker people into thinking, oh, it's a crash, I want to get out, or and I'm a short, I want to chase this to the downside, only to then just trap all the shorts and have a third or second wave higher. That's generally how markets work. So I would not really be, I wouldn't be clutching my pearls over the fact that gold goes down to 3,700 or 3,500. I actually think that's probably going to be an extraordinarily good buying opportunity. So if we get to that point and the BMA trend meter is just all red, that's probably going to be the best buying flash sign we can possibly get.
I don't think it drops below 39.
Yeah,
3,900.
I think that's sort of like the basic idea. Now, the flip opposite of gold, as far as the story this year, has been oil, right? I mean, oil has just been a disaster, and we talked about the fact that the commodity currencies, right? Commodity currencies have basically expressed the fact that there is just no demand for commodities, right? Global demand, general, demand has really come down. I don't know how much of that is a function of decline in economic activity, or how much of that is actually a function of what you and I talked about, the fact that BYD and electric vehicles are becoming a pretty big part of global, transport. Remember, cars, I think, make up, I don't remember how much, like 25% of all energy use in the world. And if the huge stock of automobiles goes from gasoline to electric powered, even if a lot of that electricity requires carbohydrate energy to keep it going, a lot of it doesn't. Solar comes in, nuclear comes in. There's lots of substitutions. So the fact that the IEEA, the International Energy, I forgot the full acronym for the agency. Basically, the agency that is the agency for energy across the world, the global agency, said that there is a 4 million barrel per day oversupply of gold as it stands right now. That the world is producing 4 million barrels more than it needs, which is kind of really interesting. But it also kind of says, I think in some ways, that we are really, really close to some kind of a corrective bottom. Because remember, nothing is better for higher oil prices than lower oil prices. Because the lower oil prices stop exploration, or they cancel lots of projects that produce additional oil onto the market, and by doing that, they limit the supply, bring it back up into equilibrium, and bring gold up. So we're looking at gold right now we're looking at oil right now as a kind of a story.
59.69.
Yeah, but look at the EMA meter. I mean, this is actually a story of a bottom. I mean, this is showing you that all the short-term moving averages have actually turned positive.
Lowest since April 2021.
Yeah, exactly. And the conventional wisdom is, it's going down, but the price action is actually telling you no, it's maybe bottoming out. That's where the EMA meter really comes in as a super handy tool that I'm happy to have all of you guys use. But when we're looking at the oil chart, it's really showing.
I think if it crosses 55, then it's really got some room to keep falling. But it seems to continue to test 55 through 57.
Yeah.
And it could, bottom out there, really, like you said.
Yeah. I mean, I think, for punters out there, oil is either as a pure natural play, or maybe through CFDs like Exxon, Chevron, the two of the largest, multinational oil plays. Could be an interesting play here. And what you're seeing just purely, if you're trading oil, to me, the EMA meter is telling you that this is a bottom, not a top, because the first half of the whole quadrant is turning green, meaning that they were kind of bottomed out. Prices have actually turned up on all of those lower time frames. So that's sort of super interesting for those people that are considering oil.